In early 2025, former House Speaker Nancy Pelosi made significant moves in the stock market, attracting attention from investors and the public alike. Her trading activities, particularly in the technology and artificial intelligence (AI) sectors, have sparked discussions about potential insider knowledge and the ethical implications of congressional stock trading. In this video, we want to analyze Pelosi's move as an investor. Subscribe to the channel as we dive right in. Pelosi's investment in Tempus AI. According to Capitola Trades, one of Pelosi's most notable trades involved Tempus AI, a healthcare-focused AI company. In January 2025, Pelosi purchased call options for Tempus AI at $15.15 per share. Following her investment, the stock experienced a remarkable surge, increasing by 160%. This surge resulted in a 330% gain on her options, translating to profits approximately 5 times her congressional salary. Continued interest in NVIDIA. According to MorningMoney.com, Pelosi's history with NVIDIA, a leading semiconductor company, is well documented. In February 2024, she purchased 70 call options with a strike price of $200, set to expire on January 17, 2025. Despite market fluctuations, Pelosi's confidence in NVIDIA remained evident. In January 2025, she acquired 50 more call options at an $80 strike price, expiring in 2026. This deep-in-the-money position suggests Pelosi's belief in NVIDIA's long-term growth potential. Strategic moves amidst market changes. As stated by Fox Business, Pelosi's trading strategy also includes timely divestments. In July 2024, her husband, Paul Pelosi, sold 2,000 shares of Visa stock, valued at over $500,000. This sale occurred shortly before the Department of Justice announced a lawsuit against Visa, leading to a 5.5% drop in the company's share price. Such well-timed transactions have fueled speculation about the use of insider information, public perception, and ethical debates. According to thetimes.co.uk, the Pelosi family's trading activities have not gone unnoticed by the public. Their investment success has led to the creation of platforms and portfolios that track and mimic their trades. For instance, the Pelosi Tracker portfolio, which mirrors Paul Pelosi's investments, has significantly outperformed the S&P 500, achieving nearly 800% gains since 2014. Despite its impressive performance, this portfolio is considered high risk due to the speculative nature of following individual trading patterns. The Pelosi family's stock market moves have become the stuff of legend, capturing the attention of retail investors, Wall Street analysts, and political watchdogs alike. Their uncanny ability to pick winning stocks has even given rise to a phenomenon: investment platforms designed to track and mimic Paul Pelosi's trades. One such portfolio, dubbed the Pelosi Tracker, has shattered expectations, boasting jaw-dropping gains of nearly 800% since 2014, leaving even the S&P 500 in its dust. This isn't just a stock-picking strategy. It's practically an underground movement. Traders and investors, eager to ride the Pelosi wave, have turned following their trades into a high-stakes game of financial detective work. However, while the returns are undeniably impressive, the risks are just as real. Betting on a single person's trading habits, no matter how successful, can be a roller coaster ride of speculation, timing, and uncertainty. Whether this strategy is pure genius or dangerously reckless remains up for debate. But one thing's for sure: when the Pelosis make a move, the markets pay attention. Political and legislative implications. The ethical implications of congressional stock trading have prompted calls for legislative reforms. In December 2024, President Biden publicly supported a ban on stock trading for sitting members of Congress, questioning how lawmakers could ethically engage in stock trading with potential access to insider information. This stance represents a significant shift, especially considering previous opposition from figures like Nancy Pelosi, who had defended the right of lawmakers to participate in the free market. By the way, if you are enjoying this video, hit that subscribe button, turn on your notification bell, and like the video. Nancy Pelosi's recent stock trades, particularly her investments in the tech and AI sectors, have reignited debates about the ethics of congressional stock trading and potential insider knowledge. As discussions about legislative reforms continue, the actions of public officials in the financial markets remain under close scrutiny, highlighting the delicate balance between personal financial interests and public trust. Cracking the code: how investors can maximize returns without huge risk. In the high-stakes world of stock trading, the Pelosi family's legendary investment success has turned heads, sparked debates, and even inspired an entire Pelosi tracker portfolio. With nearly 800% returns since 2014, this portfolio, mirroring the trades of Paul Pelosi, has wildly outperformed the market, proving that strategic investing can lead to astonishing gains. But let's be real, blindly following one person's trades, even a seasoned investor's, can be a dangerous gamble. So how can everyday investors capture strong returns without taking on enormous risks? The answer lies in balancing smart strategies, risk management, and long-term planning. Let's break it down. 1. The Pelosi effect. Learning from the pros. Without the blind faith, following high-profile traders, whether it's Paul Pelosi, Warren Buffett, or Cathie Wood, can be tempting. After all, these individuals have access to top-tier research, experience, and perhaps even insights the average investor lacks. But blindly mirroring their moves, that's where things get tricky. Instead of copying trades outright, use their strategies as inspiration. Ask, what sectors are they betting on? If they're heavily invested in AI, semiconductors, or renewable energy, research those industries and consider diversifying your portfolio accordingly. What time frames are they using? Are they playing the long game or making short-term speculative bets? Long-term investments tend to be safer and yield better results. Are they taking big risks or are they strategically hedging? Instead of going all in, spread your investments across multiple assets to reduce exposure to single stock volatility. 2. The power of diversification. Don't put all your eggs in one basket. Paul Pelosi's trades may have performed well, but what if one of his big bets went south? Many investors fall into the trap of over-concentration, meaning they invest too much in a single company, sector, or trend. The smart move: build a balanced portfolio that includes a mix of blue-chip stocks. Reliable companies like Apple, Microsoft, and Johnson & Johnson provide stability. Growth stocks, companies with strong future potential, such as AI and clean energy firms. ETFs, exchange-traded funds. Investing in broad market ETFs like the S&P 500 or NASDAQ 100 provides exposure to multiple companies, reducing individual stock risk. Bonds and alternative assets. These can provide stability during market downturns. By spreading investments, you can still capture big wins without the risk of a single bad trade wiping out your gains. 3. Options trading. A double-edged sword, one of Pelosi's most notable moves involved options trading, particularly call options in Tempest AI and NVIDIA. This is an advanced strategy that can generate massive gains, but it can also lead to catastrophic losses if not managed properly. If you're intrigued by options but don't want excessive risk, start with covered calls. This lets you generate passive income by selling call options on stocks you already own. Consider LEAPs, long-term equity anticipation securities. These are long-term options that allow you to bet on a stock's future without worrying about short-term volatility. Never risk more than you can afford to lose. Options are a tool, not a magic wand. 4. Timing the market versus time in the market. Pelosi's trades seem perfectly timed, but for the average investor, trying to time the market is a losing game. Instead, focus on time in the market. That is, staying invested long enough to ride out volatility and benefit from compound growth. A winning strategy: dollar cost averaging, DCA. Invest a fixed amount of money at regular intervals, regardless of price. This reduces the impact of market swings. Long-term holding. The best investors don't panic sell at the first sign of trouble. Stocks like Amazon, Apple, and Tesla all experienced volatility before delivering massive returns. Focus on fundamentals. Buy stocks based on company strength, not hype. Look at revenue growth, competitive advantage, and management quality. 5. Risk management. The key to sleeping well at night, even if you're chasing big returns: never risk everything on a single strategy. Here's how to keep your investments safe while still aiming for strong gains. Set stop-loss orders. These automatically sell your stock if it falls to a certain price, preventing deep losses. Rebalance your portfolio regularly. If one stock grows too large, take profits and reinvest elsewhere. Maintain a cash reserve. Keep some money on the sidelines for opportunities during market dips. Final takeaway: play smart, not reckless. The Pelosi family's success is undeniable, but their trading style isn't for everyone. Instead of blindly copying, learn from their strategies while keeping risk in check. Diversify, think long-term, and use smart risk management techniques. The stock market offers incredible opportunities, but true wealth is built by making strategic, informed decisions, not by chasing hype. Whether you're following the market's biggest players or carving your own path, invest wisely, stay disciplined, and let time do the heavy lifting.